Hi, it's me again. So I'm just going to talk about the second component of the midterm exam. As you know that there are three versions for this midterm exam. So for this question, I'm only for the tutorial purpose, I'm only going to show the version B. The mechanisms, the calculations, all exactly the same. The only difference is the numbers are different, okay? But everything is the same, other than the numbers are different, okay? So I'm going to talk about the version B, and so then you see how I do it, okay? So you have 30 minutes to work on this. Maybe some students may believe that, it's too short of time, right? But not really. I do have students achieve 4 mark on this, okay? So it's really about if you truly understand, the ins and outs of the accounting issues involved with the long-term contract. And in this particular case, it's about onerous contract, okay? It's about onerous contract. So I will show you how easy this question is, and hopefully you can learn from this question. And in the future, you're gonna know better how to deal with a long-term contract, okay? So this is the question, version B, okay? Build It Incorporation is a builder of large digital networks. In the midst of the high-tech euphoria, the company bid and won a $38 million contract to build a network for the country of India. Details on the project over the 3 years are as follows, okay? So all the information are the same, other than I changed the company name and also the price, the bidding price. So these are different from different versions, by versions, okay? And also these numbers I changed a little bit too, okay? So then you know year 1, year 2, year 3, and the cumulative cost, okay? This is a cumulative cost, not the actual cost for each year. This is the cumulative cost by the end of the year, okay? Make sure you understand the difference. And here is the additional cost to complete as estimated at year end. And amounts invoiced to customers in the year. This is the billings and the cash collections, okay? So first question, calculate the amount of revenue, cost of goods sold, and gross profit to recognize in each of the 3 years. The company uses percentage of completion method to account for a long-term contract. Okay, so show your calculations. Round any percentages to nearest whole percentage, right? When you calculate the percentage, make sure you use the percentage rounded to the closest percentage, nearest whole percentage. Okay, so I'm going to show you how this works. Okay, so here, okay, when I take a look at year 1, okay, so cumulative cost 14, additional cost to complete 25. So add them together, total expected cost is 14 plus 25, 39, right? 39, that's the cost is higher than the price 38. Right away, we know that this is the onerous contract, okay? And the loss would be $1 million, right? 38 minus 39, that's $1 million loss. Remember, according to IFRS, okay? If it's onerous contract, we have to immediately recognize 100% of the loss, okay? So I'm gonna have a loss here of $1 million, right? Okay, good, yeah. And then let's take a look at year 2. Year 2, okay, cumulative cost incurred is 26, and they need additional 12 to finish. So now total estimated cost is 26 plus 12, which is 38. That's exactly equal to the price. So at the year end of year 2, I realized, guess what? I'm not making any profit, and this is not an onerous contract. I will not lose. So at the end of year 2, I learned that the gross profit, okay, is 0, right? So you should recognize 0 profit by the end of year 2, okay? The fact you recognize the $1 million loss, that means you have to recognize $1 million profit, okay, in year 2. And then you know that the total is 6, right? The total is 6 loss. So the total of this project is the $6 million loss. So up to this point is 0, okay? -1 plus 1 is 0. And here has to be -6, right? It has to be -6 here. So we're done with the gross profit. And then the cost of goods sold. Well, that's easy, right? This is given. So the first year is 14. Second year is 26 minus 14 is 12, right? Oops. And the last year is 44 minus 26, that's 18. Easy? Yeah? Okay, revenue recognition. So then use the percentage calculation, okay? So let's do percentage equals, okay? You have 14 divided by 14 plus 25. So equals 14 divided by 39. Okay, that's a percentage. Okay, the revenue is 14 divided by 39. 14 divided by 39. So what is that? Let me take a look. So 14 divided by 39. 35.9%. So that's 36%, right? We are rounding the percentage to the nearest whole percentage. So that tells me this is the 36%. Okay, 36%. So this tells me 36%. And the revenue is 36% times 38 million. So that equals 36. Okay. So 0.0336 times 38. 13.68. Okay, 13.68. So here I have 13.68 million. Okay. Now for year 2, okay. So percentage for year 2, this is 26 divided by 26 plus 12. Okay. So this is 26 divided by 38. And the cumulative revenue is 28 divided by 36 times 36 million. So that's going to be 26 million, right? Because at this point, your total cost equals total revenue, okay? So then your total revenue recognized up to date should equal to the cumulative total cost, okay, 26 million. So for year 2, that's going to be 26 minus 13.68. That's equals to, okay, this is going to be 632, 32, 68, 12, 13. Yeah. So in the second year, it's going to be 12.32 million. And year 3 is going to be, in total, it's 38, right? 38 minus 26, 12. Okay, so year 3 equals, total is 38 minus the 26 you accumulated so far, that's 12 million. Okay, so what is the expected loss? Okay, in the first year, you expected a loss, okay? So the completion is 36% for year 1, okay? So in year 1, expected loss is 1 minus 36%. That's the percentage to be completed times 1 million loss. So that's going to be 0.62, right? 36. So that's going to be around. Okay, you can do another way. You can do it another way. So this is going to be 0.60. Yeah, 0.64 loss. And then you do another way. If you think about, okay, this minus 14 minus this has to equals to -1. So this one should be 0.68, right? So that's gonna be the number, expected loss. So this minus this minus this should equal to -1. So if you get 0.64 or 0.68, it's all correct, okay? I would consider both numbers correct. The difference is due to the rounding on the percentage, okay? And so then the next year you realize, guess what? There's no, this is not an owner's contract. You have to reverse this, okay? And then year 3, okay? Year 3 is the last year, right? So there's no expected loss because year 3 is the last year. So here's 0. So that's the part 1. Okay, that's part 1. Part 2, right? Part 2, you know, the journal entries. You should know this really well. Debit for the cost, CIP, right? So this is a balance sheet item, like a inventory. So that's gonna be how much? 40 million for year 1. And you credit cash or AP for 40 million. And you debit cash, AR, when you bill, right? So this would be also balance sheet item. AR is a balance sheet item. So that's going to be AR billing 11 million, credit billings on CIP 11 million, and cash collection debit cash. So this is going to be a balance sheet item. This billings, this is like an unearned revenue. This is also a liability. And collection 0.10, 5 million. And credit AR. All these items are balance sheet items. 0.5 million. So this entries should be pretty easy, right? Very, very straightforward. And then you recognize cost of sales. This is income statement, income item equals actual cost 40 million. And you recognize expected loss. This is also income, which is 0.68 million. And then you credit your revenue, which is also your income statement, for 13.6 million. And then you credit your liability for the loss provision for onerous contract. What's your expected loss? 1 million. Right, because in the year 1, you think this is the onerous contract, and your loss is going to be $1 million. So you have to credit this liability, recognize this liability, provision for onerous contract 1 million, and you recognize your revenue, and this would be a balance sheet item because this is a liability, balance sheet item. Okay. So that's it. That's the journal entry for year 1. Okay. So this 3 is kind of a little bit given, right? And once you calculate all these numbers, this journal entry is also quite straightforward. Okay, that's it for my review on this question.